Hello and welcome to BloombergQuint. You're watching IPO Adda, and the company in focus today is Adani Wilmar. The company is coming out with a patent issue on January 27th, pricing between 280 to 230 rupees per share, a total value of 3,600 crores issue, which is 12% of the equity of the company. And the upper end of the price band gives the company a market value of nearly 30,000 crores. And joining me today is Mr. Angshu Mallick, who is the MD and CEO of the company, and Shrikant Kanhere, who is the Chief Financial Officer of the company. Gentlemen, uh, welcome to Bloomberg Quint. Let me start with the first question. Uh, Between the time you filed your DRHP and RHP, the size of the issue has been reduced. Can you give us a reason why you have reduced the size of the issue?
Yeah, so when we filed the DRHP, with a size up to 4,500 crore, and the issuer generally is allowed to either increase or reduce the size of the issue by 20% plus and minus. What we have done is we have reduced the size by 900 crore to 3,600 from what we filed at the time of DRHP. We have actually taken out the 900 crore component of the general corporate purpose, which we had earlier envisaged, just to ensure that the issue is more capital effective, and we have stayed on only core object of the issue, which is more to do with the Capex, more to do with the repayment of term loans, and also more to do with the acquisitions and mergers. This will certainly be an optimum and effective capital to raise, and which will help us to ensure our return metrics.
Mr. Mallick, we saw one of the largest FMCG companies coming out with earnings yesterday, and they've been giving a very lukewarm commentary on the volume growth, uh, especially in the rural side. What is your assessment of how the demand is shaping up?
See, it depends on what type of product you are and what type of product cycle that company is or anybody is. Adani Wilmar, fortunately, is in the basic staples. We all agree that we all want to eat the basic food, and all of us, whether rich or poor, urban or rural, is consuming atta or dal or besan or rice. And there is a shift from loose to packed. COVID has accelerated that movement. Consumers have become little conscious about buying branded, packed, good quality product, and they don't mind paying a rupee or 2 rupees a kilo more so that they get the best products at their home. Fortune is a very trusted brand. We have seen very good double-digit growth in food. We have been growing at around 25-30% this year also in branded packed staples. In edible oil, the growth rate has been around 6% because that is how the edible oil market has been, because it's also a very matured market and almost 75-80% of it is branded. So wherever there is a matured market, the growth rate has not been very good. But yes, at 6% to 8% is the standard growth of edible oil. Food, we are new, plus the market is very big and the market is growing. Consumers are shifting and consumers are becoming conscious. If you see the e-commerce, the grocery basket of e-commerce is the biggest basket today. It has overtaken all other baskets. Now, that is because people are ordering online grocery every month. They may not order other products every month, but every month consumer require 5 kilo sugar, 5 kilo dal, they require oil, they require wheat flour, they require rice. So these are all standard products which consumers are ordering, and they feel it is good to order through e-com. So the growth rate is there, and Adani Wilmar has positioned itself as a good branded staples player.
Okay, I get the part of the double-digit growth which is coming to you in terms of revenues, but what I want to hear about is the volume growth which is coming in, because even in FY21, the growth was more than 20% in revenues. Your volume growth was 2 to 3% odd, and we have seen sluggishness in demand coming in terms of volume. And this revenue growth is primarily because commodity prices have gone up, and so the revenue is looking inflated in that sense. But tomorrow, if prices come down, it will come down as well. So, can you give me a perspective on volume growth? How is it looking? Because you are into basic
Actually,
staples.
Actually, I was talking about the volume growth, not the value growth. The value growth, the company will be doing more than 35-40% this year. So
Okay.
I am not looking at value growth. What you are right, that this type of inflationary pressures are there, so the prices have gone up. So nothing much on our side. But volume growth, edible oils are growing at around 5 to 6%. We will maintain that growth rate. Food staples basket we will grow at around 25% plus. In terms of volume, I am talking of, against the market growing at around 10-12%. But our growth rate is more because, one, we are aggressive in sales and distribution. We want to push volumes at this point of time, and we have a good brand and we have a good distribution network in place. Second, there isn't any great national brand in the country when you look at the staples basket. So the e-commerce players or anybody national player would like to have a national brand to deal with, and we are one of the largest staples brand now. So that is helping us.
So from the distribution part of it, the general trade must be around 75% and modern was 25% odd. But within the modern, how much is e-commerce now contributing to your revenue?
Absolutely, you are absolutely dot on the percentage. Let me tell you, actually 75% of the staples branded is at the GT, 25% is modern trade, but out of which 15% comes now from e-commerce and 10% from the standalone stores like the Reliance and the big bazaars. But in edible oil, if you see, it is 90-10. 90% comes from general trade, but 10% comes from modern trade and e-commerce, where 5% and 5% is divided. But e-commerce is growing at around 50% or 55% per annum, whereas the modern trade is growing at around 12%, 10 to 12%.
Before I come into the specifics of the operations, I just want to get one more question off here. We have seen a lot of distribution led issues. GT versus modern trade, GT versus B2B and e-commerce. Where is your stand on that, and how have you handled that issue?
See, thankfully, Adani Wilmar has not got into this issue of price war between GT and e-commerce or modern trade. We have been always working on a model where we take care of the general trade as much as we take care of the e-commerce. That is one. Two, the pricings are almost very transparent to each other because, in edible oil and staples, the price transparency is very high. Many consumers also connect between what is happening at DMart or Big Bazaar or GT, and they compare the rates. So, everybody is comparing the rates so much day in, day out, that you have to be very open and transparent. Second, we are working with direct B2B players like Udaan and Jio and all that, because they are also our partners in distribution. They also help us in reaching to those outlets where our distributors cannot reach. So for us, for Adani Wilmar, both are important. General trade is important, my distributor is important, my direct B2B is important, my e-commerce is also important, because e-commerce is reaching to the consumers directly at their home. So all the channels needs to be promoted and taken care of. Thankfully, we have been away from all these issues, and so far so good.
I agree the part of distribution and how each channel is relevant in its own form, but I think the major issue comes in when the pricing is the issue, right? In GT is a different
Yes.
pricing, in e-commerce and B2B is a different pricing. How are you handling that challenge?
See, there is absolutely very transparent. There is not much of price difference. The distributor might get little benefit because he is going to an outlet, he's spending money for distribution, and he's a very small entity. So his business depends on our business. His earning depends on our business. So we have to be a little more generous towards him. Rest of the modern trade and all that, they are otherwise also handling big volumes, and the margin structure is also equally good for them. I don't see a great price difference in our kind of products to them.
Shrikant, coming to the financials, you're raising 3,600 crores. and you said it's capital intensive in that sense. I was going through your balance sheet, and you had a current liabilities or working capital of nearly 10,000 odd crores, which is there. Uh, why haven't you looked at raising capital to augment your working capital?
See, I'll just give you a very quick answer on this. So most of our working capital is funded by the creditors. So, it's more of a non-funded banking lines which we have been able to utilize for our working capital, and which is basically a dollarized funding which comes either directly from the creditor or it comes directly through a non-funded banking lines.
Mm.
And so therefore there is no point in raising a capital to pay off this funded non-funded lines, which normally you are able to raise at a very lower rate. So there's no point raising a high cost equity to pay off such kind of arrangement.
Mhm. I also see that you have a hedging a strategy in place, not only for forex but also for commodities. But last financial period and FY21, I've seen you have been posting losses on that. Uh, what is the strategy, and what is the total hedge as of today?
See, we have a very robust integrated risk management structure in place, and it's very important for our business where 70% of your raw material is imported. So therefore, you are open for a commodity and currency risk and the counterparty risk. To mitigate all this, we have a board approved proper structure framework within which our management works. Now, hedging mechanism, it works like this. And the whole purpose of taking a hedge is to mitigate a risk of a price fluctuation. So therefore, when you take a particular hedge, if you lose on hedge, you gain on the inventory or you gain on the price realization from the customer. If you lose there, you gain on the hedge. So when you look at only one part of it saying that there is a hedge loss, it's not actually a hedge loss. It's actually a hedge cost which is getting shown in the balance sheet and the financials. The opposite leg of it, if it is a loss, the gain is sitting either in the inventory or it has been already recovered through our price realization. Having said that, we typically work within the framework which is given to us by the board, which is a very tight framework within which we work. And that's also a reflection that why our margin structure is more or less steady state, which is growing at a steady state of 20% EBITDA for last 5 years CAGR.
I get the point where you're talking about, you have to look at both ends. But my point is that, if you're having a loss here, you should be able to gain from inventory or sales. Have you been able to pass on the entire cost to the consumer? Because if you don't pass on the cost, then you are putting pressure on your margins.
I think that's where the whole equity of a brand comes in play. Yeah, if you have a very, very strong brand in place, the brand itself act as a hedge for you. And we are fortunate that we have a Fortune, which is one of the strongest brand today in India. So we are able to navigate through all these commodity cycles, up, down, any inflationary pressures, and that's what also been getting reflected in our margins year after year.
How much of price hikes have you taken in the last financial year?
Maybe I request Mr. Mallick to take.
Yeah, Mr. Mallick.
Yeah.
See, the price hikes are in line with the commodity hike that has been happening, correct? In the last 1 year, if you see from a low of 120-25 rupees per kilo for sunflower oil, it has gone up to 185 rupees a kilo. So the same happened with mustard oil. So these happens at a gradual stage. So we have been able to pass on the price to our consumers, and there has not been any anti or backlash on it. However, the inflationary pressure was felt by everybody, honestly, mainly because of the petroleum and diesel price hikes, and then followed by edible oil, because edible oil price hike was seen after a long time. I don't think anybody has seen in the last 5 years edible oil prices going up as much as we have seen in last 6-8 months. So consumers were really worried. We got a lot of queries or questions from our consumers that is the retailer charging me correctly? Is it that he's overcharging me? So we would convince him that no, this is the price and this is what it should be. So that is how it is. But then government intervention came at the right time, and then the reduction in duty, and the commodity prices also from the top has come down. So both put together have reduced the price by almost 15 to 20%. So today the consumers are at 20% lower than the peak. So it's now an acceptable price, I would say. So we are away from that inflationary issues.
Yeah. What is the normal time lag between you pass on a price hike or a price cut to the consumer?
Normally 15 days.
15 days.
15 days, because that is what pipeline that you carry.
So do you see commodity prices now stabilizing at the current level? You see see it further going down?
The commodity prices are by and large stable. Of course, last few days the markets have jumped for some weather conditions. Normally, this time, this type of weather issues can happen because South America is going for sowing season, and now they will sow the soya bean. So every day the monsoon and rains in Argentina is being discussed more than rain anywhere in the world. So that happens, and we are aware of it. So one day, a dry day or a wet day can create a problem. But by and large, we don't see any great changes in the commodity prices. We feel that its market is going to be stable. India is waiting for a very big mustard crop. Against 80, 85 lakh tons, we are expecting around 120, 125 lakh tons. So around 40 lakh tons more. So if you have 40% oil, so you get around 1.6 million tons of more mustard oil available in the country. I am sure that will reduce the pressure of imports, and that will also send signal to the world that India's consumption of imported oil will reduce, and the commodity prices will come down.
Mr. Mallick, you're spending around 1900 crores for your Capex, which includes, I think, expanding your food processing industries and all. Can you give us an idea in which are the areas which you're trying to expand? Because if I look at your existing plants, your crushing plants are utilized only 20-25%. Refineries are 50 to 60%. So adding that food capacity, how much of it you will be able to process it and push it into a revenue stream?
See, instead of looking at an average, what we do is we look at a specific plant and a specific geography. Now, you see mustard, our mustard crushing is at around 75 to 80% capacity utilization. What you are seeing as an average crush, that is because of the soya bean, and we have very large crushing facilities of soya bean. But soya bean this year and last year has been disparity. And so every ton you crush, you don't make money. Except that we have value-added products. For that, we are surely using it. So 25%, what you see we are doing is because we have a value-added soya flour, soya lecithin, soya sauce meal, soya nuggets, and soya value-added products. But the main crushing of mustard is around 70-75%. If you see the crop of mustard that is coming, and the way India is pushing for the Atmanirbhar program of agriculture, and what the Prime Minister has said that I want more and more oilseed growth. So we expect mustard crop to be much bigger in days to come. So we are preparing for that. So we are putting two big 500 tons unit, crushing unit, one in Haryana and one in Rajasthan, to take care of the future requirements of mustard seed crushing. Other than that, most of the projects are in food, where we are putting basmati rice, non-basmati rice. We are putting dal line because we have besan. We are putting dal line so that from dal to besan, we can make at one go. That will reduce our cost, bring out efficiency, and help in making, we are also very large suppliers to industry. We make frying oil. We make a lot of specialty fats. So all our frying oil goes to KFC and Haldirams and all that. So all these people also need besan. They need dal. chana dal for the snack foods. So we are going to make best quality dal for them as well as for the consumers. Then we have plans to get into wheat flour. So we are putting wheat flour. We are putting refined wheat flour, that is maida. If we have good quality maida, then we can get into pasta, noodles, and other things. So one by one, we are getting into. So once the base, that is the staples base, is ready, after this you need upgradation. So if your flour is ready, you can go for noodles. If your rice is ready, you can go for rice snacks or rice-based powder, or for fortified rice, or for any other type of rice you can go. So what we are now doing is putting the base staples ready for the next stage of value addition.
When is that expected? By when do you see that value added products coming into the market?
See, these are step by step we are happening now. In wheat flour, we already have factories, so we are going for multigrain. Then we'll go for high protein. Then we are going for some other varieties of this, and maybe ready to eat paratha or something. So if your base is ready, then one can get into all this. So stage by stage we are getting into. We already have khichdi, if you are aware of, ready to cook.
Is there a timeline for these products to come into the market?
See, one by one, we are getting into that. Khichdi, I have got into 2-3 new varieties. We are making do by yourself biryani kit, because we have basmati rice. We understand the flavors. So we are putting that in the market. We are putting different flavor of rice, say Mexican rice or Thai rice and all that. So all these are in the pipeline. We have just launched poha. If you know, poha is a very simple product, nothing very great. But we have got into details of from which paddy it is made, what kind of paddy can give you the best quality poha. And we have seen that in Chhattisgarh, there are areas where if you buy the paddy and you keep it for a year, the paddy quality is so good that the poha is so good. It is much more sweeter. It has that much more chewiness. So we have put the Indori poha in the market. So each of the products that we work on has the daily necessity, but we will try to give you the best quality at the most competitive price, because we have a distribution in line, we have supply chain, we have a brand. So that is all the advantages that we are going to put in.
What about the storage part of it? Because while your storage is catering to all the seasonal things, for off-season sales and arbitrage, you don't have enough storage capacity. What is the kind of additions you're doing there?
See, we have a wonderful mix of products. Let me tell you, very few companies can do this, that during the Kharif season, we buy paddy. We are buying soya bean. Same traders are buying it. We have flat go down. We have silos where we store soya bean. Now, these soya bean seeds are for 6 months, after which I can convert it into wheat, or I can convert it into a mustard seed silo. So, because we are also in mustard seed, which comes in March, we are in wheat, which comes in March, we are in chana, which comes in March. So I have 3 big crops in Rabi season, and I have 2-3 big crops in Kharif season. So what we do is that we use the same warehouses for 6 months, one warehouse, and another 6 months we use another warehouse. And that is how we reduce our cost and overhead, both manpower, integrated factory, integrated storage system, and then processing lines where same rice unit will also have the dal unit. So quality control is same, R&D is same, factory manager is same, security guard is same, way bridge is same. So all these things are same. So our cost gets distributed, and your cost of operation becomes low. So we become more competitive, and that is how we pass on all the benefits to the consumers.
Shrikant, Mr. Mallick spoke about how he's going to go downstream with value-added products. You have a margin band of 3.5 to 4.5%, which is EBITDA margin band, which is there. How is this movement from current what you produce to value-added products, as and when you launch, improve your margins? And when do you see that margin band to move up drastically? You are into FMCG business where margins are supposed to be higher. Your margin profile is in a band of 3.5 to 4.5%. The street would like to see if your pure FMCG products are moving towards that, how the margin is going to improve as well.
See, let me first also highlight one is that we should not be looking margin as a percentage on a standalone basis, because there are industries and there are business model where you have a EBITDAs of plus of 70%, but at the end you doesn't left with any net profits. And those are typically a capital intensive industry where everything gets eaten up by depreciation and interest. So while I agree the margin profile is 4.5-5%, which is an industry norm actually. This is how this industry behave, whether it is a staple food or whether it is a edible oil. But what you should be looking at is that this margin structure in conjunction with what kind of asset turn a company has been able to produce. We are very efficient in turning around our assets. Our asset turn is today at 8-9 times, is a pretty high asset turn for any company to achieve. And therefore, when you combine both of these, riding on this, basically you are able to give a healthy return matrix of 22% on return on equity in spite of a EBITDA range of 4.5-5. Coming back to your question, how does it improve from here? Yes, very valid question, because since we are now focusing more and more on food and FMCG, typically food and FMCG gives you better margin as well as compared to the edible oil. As Mallick ji explained that we have started our journey only 3-4 years back as far as the food is concerned, though today we are fully transformed food FMCG company of India. As we move forward in next 5 years, the more food and value-added products, maybe a small SKU, but a very high margin products, just like Mr. Mallick explained, some of the ready-to-cook and ready-to-eat categories keeps adding on to the basket of a company. I think the margins will start improving from here. This is one part of it. The other is on an edible oil, which is a fully matured business for us, and we are a strong number one player in the country with a very robust brand in our side. There also a consolidation will keep happening because you are gaining market share. And as Mr. Mallick explained, that 60% of market today, branded market, is still in the hands of a smaller players, which are a one region, one state brands. So that market share consolidation will keep happening, which will also add to a margin consolidation. And therefore, we are very hopeful that whatever kind of performance we have been able to show in last 5 years on EBITDA, which is 20% CAGR, we should be able to continue with that such kind of indicators.
That brings me to the second question, because you earmarked 450 crores for acquisitions. So I want to get a color of what kind of acquisitions you're looking at, which areas you're looking at.
So see, as we said that the whole focus of the company for next 5 years is going to be the food. And this is the basket. We want to take it up to a next level. Today, our food portfolio, the volume is around 11%, whereas edible oil is 65% and the rest of 24% comes from the industry essential. This 11% of food basket we want to go, and therefore whole focus as far as the merger acquisition is concerned would be in this segment. We would be looking out for the brands, we would be looking out for the companies, we would be looking out for the assets. Any part of the India, it can be any food brand, it can be any one single state brand, which can gives us a flip, because we have a huge distribution. Because there are, many times happen, you have a brand, a very good brand, but since they don't have a very high distribution reach, they are not been able to reach out to every nook and corner of India. We have the distribution in place, and that strength we have. So we can look at the brands which are right now concentrated in one or other state, but if we acquire them, we can make it a pan-India and spread it. So that's the whole strategy which we would be looking at in next 5 years as far as the mergers and acquisitions are concerned.
If I look at your company profile and the present segment you're present in, your real competitor is actually Patanjali and Ruchi Soya. Others have one or two segments of what you are present in, right? Mr. Mallick?
See, I wouldn't say they are the strong competitors for us. For us, we are clear number one. That is, second, we have the portfolio of oil for all the markets. So we are number one in mustard oil, which is a big oil in the country. We are number one in soybean oil. We are number two in palm oil. We are number one in rice bran oil. We are number three in sunflower oil. So any oil that you take, we are either 1, 2, 3. And mostly we manage the business through the strength of the brand and the distribution. So I am not comparing with anybody, and we are not worried about anybody. We feel that it is for us to see where we want to grow, how we want to grow. See, we created this category rice bran oil in India. Earlier, rice bran oil was never sold. We came and we did it. 20 years back, when we launched soybean oil, let me tell you honestly, you have named this company. They are the leaders of soybean. They started in way back 30 years back, 40 years back, but never did anybody promote soybean oil so aggressively and so very profoundly the way we did. We created a difference in the oil. We brought in technology which India has never seen 20 years back, and we became the market leader in 2 years' time. Similarly, Kachi Ghani, the word Kachi Ghani has come because Adani Wilmar created this, coined this word Kachi Ghani as a process. Today, even FSSAI has named it Kachi Ghani, means it has to be 0.2 allyl and above. How has this name come? Because we have created this category, we have created the words, and that is how rice bran oil has been created. Low sugar Vivo we have created. Like this, Adani Wilmar has always been in forefront of bringing brands or products which are different and new to the country. So we aren't afraid of anybody. We will continue.
No, I'm not talking about being afraid. I'm trying to say that, based on the assessments that you have given in the RHP and the presence in segments, it seems Ruchi Soya, Patanjali is the closest competitor for you. That's what I'm trying to say.
Yes, number two, surely number two is close, but they are at 7%, we are at 18%. So to that extent, it's okay. Yes, they are number two.
My other question was with respect to the group's presence in sugar segment through Sri Renuka Sugar, which is also a listed company. Is there a plan to merge both the companies and become a consolidated company? Because you are already into agri and commodities, and they are also into sugar.
See, Wilmar is number 2 worldwide player for sugar refinery. They have very large business in Australia, Brazil, and other places. Obviously, India is a very big consumer and producer of sugar, so logically they are there. So this business is Wilmar's sugar business, or the sugar desk, which handles the global sugar business. We are in sugar because sugar is a kitchen essential, and consumers have been asking that if you can give me rice and atta, why can't you give me sugar? And that is how through some of the interviews we got this idea that why not get into sugar. So obviously when you want to get into sugar, and when Wilmar has the Renuka sugar in the country, so our first option is to go and ask them to help us out in giving us the best quality product so that we can do it, and we are doing it. But this does not bind us with only buying from Wilmar. Adani Wilmar can buy from anybody, source sugar from anybody, and do it. Country has large number of people. The sugar industry is very big, and a lot of players are there. Not many players are brand oriented, or neither they want to invest in brand. We have a brand, we have a distribution, so we only need sourcing. So for us, cheapest and the best quality sugar if we source, we can be a big player. And let me tell you,
just to interject you here, is there a plan at some time in the future to consolidate both options to bring in more synergies?
So let me attempt this. See, Renuka is a 100% Wilmar holding in the company, and Adani Wilmar is a 50-50 JV. So as of now, we have not thought of this. It's a different business model, which is Renuka Sugar, which is more into a manufacturing and then marketing. Ours is a different model. What we are doing as far as the sugar is concerned is only leveraging our brand Fortune, which has got a very big strength, to ensure that we have one more product in our portfolio. But these are the two different companies. One is the joint venture, one is the 100% held as well.
No, I was looking at more synergies coming in because you have a common promoter between two companies. So that's the reason I was trying to ask that. But thanks, Shrikant, for the clarification. My final question, sir, you have exports and more than 50% of that goes to China. Have you seen some kind of disruption there? What kind of growth you're seeing in your exports?
No, see, we don't depend on export to China. China buys soya sauce meal, but so does Japan, and Korea also buys. So
50%
we are
of that
not
goes to
overly.
China actually, right? Of a total export go to China.
No, in castor oil also, it goes to China, but it also goes to Europe. So far there is no disruption. Number one, so far there is no problem in the business. But we are not overly dependent on China because we have other options. We were sending it to Wilmar China, but then Wilmar Europe is also there and Wilmar Japan is also there. So we work with them anywhere in the globe.
Okay, gentlemen, I'm running out of time. Thank you very much for joining us. Adani Wilmar IPO, which opens on Jan 27th and closes on Jan 31st, is priced between 218 to 230 rupees a share, giving the company a market value of nearly 30,000 at the upper end of the price band. Thank you very much for joining us today on BloombergQuint.
Thank you.
Thank you.
Thank you.